The uncertainty of financial instability can feel overwhelming, but imagine a different reality, one where you own properties that generate consistent income month after month after month, giving you the freedom to live life on your terms. In today's video, we're going to dive deep into the world of multifamily investing, and that is a proven strategy that can unlock the door to financial independence and transform your life. We're going to walk you through every step of the process. And whether you're looking to supplement your current income, build a robust investment portfolio, or just secure a comfortable retirement, multifamily is the answer and can help you achieve your financial goals. So let's get started on this exciting journey together. My name is Stacy, and I'm with RMFI Academy, where we empower working professionals just like you to achieve financial autonomy through multifamily investing. Okay, so what is multifamily investing exactly? There's different types of multifamily investing. There is 2 to 4 units, which will be considered residential. And then there's 5+ units, which is considered commercial. And we're going to be talking about both of those. That 5+ units, the word we use for that is apartment buildings. For 2 to 4 units, the word we use is plexes. So let's begin by just talking about the difference between single family homes and multifamily investments. At the very core, the biggest difference is risk. When you have a single family home, awesome, that's amazing, congratulations. You have one tenant. What if something happens to that one tenant? They could get divorced. They could lose their job. They could get ill. Like there's so many different things that could knock your tenant out of the ability to pay a monthly rent. That means you have no income coming in. But guess what you do have? Money going back out. You have your mortgage payment, you have maintenance, you have now utilities. Like there's so much money going out and there's nothing coming in to cover that. So where's that money supposed to come from? It's going to end up coming out of your savings. Getting started in rentals is the most powerful thing you can do, but getting started in multifamily will decrease the risk. So let's just even talk about the smallest multifamily, a duplex. A duplex is 2 doors under one roof, and it could either be a house with 2 different doors, each one is its own unit, or sometimes it's up and down. Let's say you have 2 tenants in there and you're cash flowing and it's amazing and awesome, and something happens with one of your tenants. And now the income from that unit has stopped. Well, the other unit is still paying, so you still have an income coming in to cover most or all of the expenses that are going out. So from a risk perspective, which do you see as more risky for draining your savings account? It's obvious, right? So you want to get started in multifamily because the more units you have in one property, the more rents you have coming in, so that if something happens to one tenant, it doesn't knock you out of the game completely. All right, next, let's talk about the different types of multifamily properties. Let's talk a little bit about the pros and the cons of each type. So if you are just getting started, everything is new. It feels like, oh, this is a big learning curve. So when you're getting started, starting in residential, that's 2 to 4 units, is a little bit easier to get started in. The only challenge to that is that sometimes, especially when interest rates are higher, it can be hard to cash flow those. So you might have to go through more properties to find a good deal. But that's a big pro to 2 to 4 units is there's just more of them. So there's more inventory. The prices are also lower. From a barrier of entry standpoint, there's a lower barrier of entry, right? It doesn't take you so much capital to be able to get started. The cons of 2 to 4 units versus 5+ units is you're not going to have as much rental income coming in. But that's actually not even the biggest part of it. And I'm actually going to use the 5+ to explain how great those are. And that will show you like where the difference is. No matter where you start, yes, it's all good. No matter what, eventually you're going to want to do apartments. But if you're the type of personality where you need to do a couple duplexes first just to feel comfortable, cool, do that. You'll probably end up selling them in a few years, but that's okay if it helps you get started. So with 5+ units, those are considered commercial. And one of the biggest differences between residential and commercial properties is how they are valued. So if you've ever heard the word comps before, it stands for comparable sales. Anything that is 1 to 4 family residential is based on what other properties that are similar to that property in the same condition. So the most your 2 to 4 family can ever be worth, whatever it is, something similar has already sold for. So you don't really get an opportunity to control the value of the property, right? That's what you're used to. Well, when you get into commercial 5+, it's a whole different game, and there is a lot of opportunity and a ton of money to be made. Let's just use a 10 unit, for example. When you buy that 10 unit, the value of that 10 unit property is not based on comparable sales. The value of the property is based on the net operating income, the NOI. And I will get more into that as we get into this video. But the most powerful thing about that is you come in as an operator and you can start increasing the income of properties. Is you see opportunities to decrease some of the expenses. Both of those things increase net operating income. Every dollar that you increase the net operating income has a massive, massive multiple on the value. Now let's talk about how do you get prepared from a financial standpoint. Your credit is going to matter a lot when you're working in 2 to 4 units. Your credit is not going to matter so much when you get to 5+ units. When you're dealing with 2 to 4 units, the way that a lender or a bank is going to look at you is the same way that they look at you if you had a single family home. Your credit score, your income, even though you might have a 4-unit property that's bringing in, $2,000, $3,000 a month, they're looking at you. Like, what if all of a sudden there's no rents coming in? Can you cover it? A good solid job with W-2s and tax returns, and you have to make enough money that you could show the bank that if you had no income coming in, they're still going to get paid. Now, when you step into the commercial world, it's different. Why is it different? It just is. With a commercial loan, what they're looking at is the performance of the building. They're looking at it as if it's a business. You're buying a business. I mean, unless you're making like crazy good money, there's no way that your income from your job is going to cover the mortgage payment on a 10-unit property. If they ask for tax returns, the only thing they're looking at is, have you been filing? Because they don't want the IRS to put a lien if you haven't been filing your taxes. They're going to look at the revenue, the operating expenses, and they're going to look at the history to see how does this property perform month over month and year over year. And they're going to make their lending decision primarily based on that, not based on you or your income. That said, they will look at you secondarily. They're going to want to see how much capital do you have in the bank in case something went wrong and you needed to fix something unexpected. They are going to look at your credit score, not because there's a credit score threshold like there is with 2 to 4 units, but because they just want to see, is there anything we need to worry about? They're going to look at your credit. Now, there are certain things that you can do. Have your tax returns for the last 2 years scanned in your computer, ready to go. Have your W-2 from last year. If you can find online, it's the Form 1003, and it is a standard PFS, your personal financial statement. So I promise you this, if you will take some time ahead of time to go through that form, they're going to ask for every little dollar of everything. They want to know, what are all of your assets? What are your liabilities? Like, what do you owe against those assets? And the thing is, it's not like that is so hard to get. It's just time consuming because you're going to be looking at your credit report and looking at balances and getting on your bank. If you're having to start that from scratch, it can be a little bit stressful. So one of the best things you can do to be prepared is get that personal financial statement done, because I guarantee you, if you're doing anything that's 5+ units, they're going to ask for it. All right, let's next talk about market research. If you live in New York City or San Diego, unfortunately, you're not going to be investing where you live because the ratio of prices and rents are just so far off that there is no positive cash flow, is to produce a monthly passive cash flow. So if you're going to go invest in an area and it's going to be negative cash flow, what was the point? I've been investing for over 20 years. And since day one of my investment journey, everything I've done has been done remotely. So how do I decide where am I going to invest? So I have to do some market research to make sure that the area I'm picking is going to be a good area to produce cash flow. So when we're doing cash flow, there's a couple of things we're going to look at with a market. You want to see that there is at least steady, if not growing, population. So if you are in a market and you have a 10 or 20 unit building and the population is starting to go down, 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 but all of the units that already existed are still there, what ends up happening is now the supply has gone up. Now there's a lot more units than there are people. It goes up, the demand goes down, right? It's always opposite. So you want to look ahead of time and find an area that the population is growing, at a minimum, holding steady. So if you're going to invest in a market where people are leaving, you're going to put yourself in a difficult position for building long-term wealth and maximizing your net operating income. All right, once you've chosen your market, what's next? Now you need to build a team. You are not going to be there. I'm going to encourage you to invest the same way a remote investor invests. because it's far more scalable because it takes a lot less time. So I build a team of professionals that are boots on the ground. So you're looking at things like your realtor or your broker. Probably the most important one is the property manager. So the property manager is going to be the one boots on the ground that knows everything that's going on in those neighborhoods, so they know the right amount to charge. They're the ones who are getting called when the toilet goes out or something like that, happens. But another important part of your team is going to be your inspector. If you are doing 2 to 4 units, you're looking at a home inspector. They can do 2 to 4 units. When you get into 5 plus, it depends on how big it is, but you're usually moving into a building inspector. Both of them do the identical same thing, but either way, it's a similar skill set. All right, so how on earth are we going to find these people that are 2,000 miles away? Oh my gosh, Stacey, how is that going to happen? So let's say you're sitting at your desk at home and you're doing on your computer, and all of a sudden, what's happening? There's water dripping on your face. Man, you have a leak in your roof. What are you going to do? Flip open your laptop, go to Google and search for roofers in your market. That's the way that we do things today in real life. So you're going to go to those websites, dig in, and start making phone calls and vetting them. Not everybody works with investors. It's very different when you're investing in a property for the purpose of business, for cash flow. So when you're talking to team members on the phone, you're going to start getting a sense for, are they more homeowner focused or are they more investor focused? All right, I know I am throwing so much information at you, and I'm so glad that you're here. One thing I just thought of, and I want to make sure that you know about it. So we have this free resource where it's a website, and we've had 7 or 8 of our best masterclasses are there. We used to charge for them. Now we've just made it free. It's just our gift to you, the new investor who's trying to get started. So if you go to the website, so www.warriorsofwealth.com, the very next page, you're going to see all these masterclasses. This is like in depth. That's really going to give you the meat and bones of every single subject and get you deep on that. Once you've selected your market, you've built your team, it's time to find your first property. Now, if you've been doing any amount of research, you've probably heard lots of ways already, but let me just save 90% of your time right now and tell you the one strategy that's going to give you the most results. And it's probably going to shock you because you've probably heard there are no good deals on the MLS. Every investor who's new, who hasn't actually closed properties yet, they all say the same thing. That is baloney. Now, I'm not saying all the good deals are on the MLS, but here's the thing that's going to save you all the time. If you will leverage realtors and brokers, it is going to be a game changer. You get all of your properties through there, and you don't have to spend all of that time and money driving for dollars, sending letters, making cold calls. Let's say you see a property that's normally listed, and the person listing that property, most likely, if they're listing anything that's a duplex or more, they probably specialize in investors. So let's say you call a realtor and you say, I just saw your 3-unit property. They're probably going to ask you a question of, well, what is your criteria? And so what that does is that opens up the opportunity for them to find out more about what are your goals and what properties that they might have access to would fit that criteria. You want to build the relationships because yes, those properties are on the MLS, but what about all the other deals that those realtors have access to that are not on the MLS? Have you heard the term pocket listing before? Pocket listing is just another way of saying it is an unlisted property, especially when you get into apartments. When someone goes to list with them, brokers will keep that property out of the public, and they are first going to call their database of buyers. Because if they can sell that property to somebody that's already in their investor pool, they'll get to double end the commission, meaning they'll make twice the commission. Where if they list it and another broker ends up bringing in a buyer, they're splitting that commission. So realtors and brokers are hands down the best way to leverage your time and start getting leads in that meet your criteria. Now you have deals coming in. We call that deal flow. Right? So you have deals coming in because you've talked to multiple realtors, multiple brokers, and they're sending you things for you to look at. Most of the deals that you look at that get sent to you, especially when you're new, are going to be no good. So analyzing properties is the next step. And you're going to be analyzing, going, oh, nope. And then all of a sudden there's going to be, wait, hold on a second. The numbers work. Well, if your goal is cash flow and you're putting your numbers into your analysis tool and you see at the end, wow, that has a pretty healthy cash flow. The other thing that we're using to evaluate that metric is return on investment. So when you're doing any kind of real estate, it always requires some amount of capital. It doesn't mean it has to be your capital, but it does require capital, either yours or a partner or a couple of partners. And you always want to make sure that the money that's coming in from the investment, that's actually a good return on investment for all the money that was put into it. The thing is, when someone is selling their property, sometimes they're looking at their baby like it's their little baby and it's the prettiest baby they've ever seen. And they're like, oh, this property is so great. And you got to make sure that's actually true, because there's usually some disparity between what the seller presents and what is actual reality. So what we do to find out like what is real about the property, like how much income is actually coming in, we do that by conducting due diligence. And there's two types of due diligence: financial due diligence and there's physical due diligence. Physical due diligence, when you get an inspector, that costs money. You're going to be looking at what's called a rent roll. And a rent roll is simply a list of what units you have, what tenants are in them, and how much monthly rent comes in. Oftentimes, their security deposit is also there. How do you verify that those numbers are correct? I want to see a source document that proves to me that this Excel spreadsheet that this person gave me is accurate. So I'm going to ask for leases on every single tenant. And I'm going to compare what does it say in the lease to what does it say on the rent roll. The other thing you're going to do is you're going to look at something called a T12. It's short for a trailing 12 months. And it shows you all of the income and expenses month by month by month over the last 12 months. You want to see on a detailed month by month basis, because that will allow you to dig in a little bit to areas that don't quite look right, ask some questions, and ask for support. So all of that is financial due diligence. And you want to knock that out as quickly as possible, because if the deal is a no-go, why would you go spend all the money on the inspection? The other thing is your building inspector or your property inspector is going to go look at all of the major mechanicals and make sure that structurally everything is good. All of these things in due diligence give you the information to know that, yes, I'm buying what I think I'm buying. Next, let's talk about making an offer. Now, this is something that when you're new, it will probably terrify you to death. But just know, every successful investor before you went through that same uncomfortableness, that same fear. So when you get into 5+ units, one of the most common things that you'll see is that the way that an offer is made is actually not on a purchase and sale agreement. Yes, that can be scary, but you start going into 10, 20, 30 units, that gets even more scary. So the way it works is a letter of intent is just simply maybe 1 or 2 page document. And it's kind of the equivalent of you writing a little note saying, hey, Mr. Seller, I'm interested in buying your 20 unit building, and this is what I'd be interested in paying, right? You're just kind of giving them an overview of, I'm interested. Are you interested? Because the thing is, if they're not interested, you don't want to go through all the hassle of filling out a 20-page contract. You'll submit that LOI. LOI is letter of intent. Even if the seller signs saying, yes, I'm interested, it's still non-binding. Let's talk about how much do you offer? I'll tell you something right now. Every seller wants this much money, and every buyer who's an investor is like, I can only pay this much money. What you have to do is you have to find what is that middle ground. This is what will make the property work. Well, if you're going to have financial freedom, that means you need to have cash flow coming in. If you offer the seller this just because he wants it, but to your own detriment, you didn't put yourself any closer to what your goals are. It's important that you remember that you are building for your future, for your options to live the life that you want to live. So you offer whatever you can pay that gives you the proper cash flow and return on investment to make the business decision you're making make sense. Okay, so you found a property, you did your due diligence, you closed, and now you have it, right? Now is when your property manager steps into the mix. A property manager who is successfully running your property, they're going to look for ways to maximize the revenue and decrease the expenses. If they didn't do a good job screening tenants, then they might have someone in that unit that just stops paying. Well, what does that do? That brings your revenue down, right? So the property manager, as a first line of defense, will have a very screening process. The other thing about property management, you always want to ask this question is, what happens after hours? Because the last thing you want to have happen is to find out after the fact, 6 hours later, 10 hours later, that there's something major going on at the property that could have been fixed or turned off. And now it's a huge problem. So it's very important that they have like a 24-hour maintenance line. All right, let's just talk about rent collection. Well, first of all, you don't have to worry about that. That's your property manager's job. But the one thing I always do, and the tip I will give you, is never allow your property manager or anyone to accept cash. There always needs to be an electronic trail so that you can trail back where did the money come from. Unfortunately, people who see that makes them a target to get hurt or attacked or anything like that. And that's not something we're trying to do at our management company. All right, we talked about property management. You are the business owner. How do you maximize your return on investment? It's always going to be, how do I get more revenue or how do I decrease expenses? I feel like the increasing revenue is fairly obvious, but I'll give you one thing that maybe isn't so obvious. So on the revenue increase, you're looking for what other ways you can add value. What can you do for the tenants? It's not just about me, what can I get? It's how can I add value that makes them okay with wanting to pay me more? Putting that aside, let's talk a little bit about expenses because sometimes it's not as obvious. You're going to look at the T12 when you're in due diligence and you're going to look to see, are there any inefficiencies going on? And if you don't see anything that's super obvious, but you do notice that, let's say it's a 10-unit building and there's one giant utility bill, like the electricity bill is huge every month. And oftentimes people that buy a building and they're just managing it themselves, they're not operating it so much like a business, they don't necessarily realize that you can do something that is called RUBS, Ratio Utility Billing System. And it allows you to bill back a portion of the utilities back to the tenants. So that brings in additional money to you. But what it does is it takes your utility expense from $5,000 a month down to maybe $500 a month and has a huge impact on the value of your property when you're talking about 5+ units. You're looking for any opportunity to take those existing expenses and chop them down. The smallest little change can impact your property value by 6 figures, by 7 figures if you get enough of them. Okay, now that you know how to get started in multifamily investing, let's help you understand how to find the right property, how to finance it, and what major pitfalls that you should avoid. I made a whole series of videos that go deeper into every single one of these topics. So click the video that's on your screen right now, and I'll see you there.